Hey everyone, and welcome back to today's Explainer. I'm Steve, and right out of the gate today, we are digging into a massive, violent shakeout on the tape. Seriously, the equity markets didn't just hit a minor speed bump today, they suffered a brutal multi-hundred-point intraday flush. It literally reshaped the entire technical landscape. It's a real-time reminder of why you can never, ever look away when high-impact macro data drops. We've got a ton of ground to cover, so let's just open the ledger and see exactly what shifted all this capital.
So, looking at the board, the Bears absolutely took the wheel heading into the weekend close. I mean, across the board, we're seeing some serious technical damage. This isn't just your everyday run-of-the-mill dip, right? This is a heavy flush driven by what we call red folder news. You know, that high-impact economic data that forces institutional hands and triggers those massive liquidations?
Okay, let's dive right into this. Section 1, the technical market reset.
This reset was really driven by programmatic selling and some wildly aggressive institutional margin calls. Just look at the S&P futures here, the /ES. It violently unraveled. I mean, we're talking a massive red candle cascading all the way down to a live print of 7,364.00. And what's super noticeable here is how the price action cleanly sliced right through the daily 20-day simple moving average. That kind of move completely shifts the near-term momentum, and it shows you exactly how aggressive the sellers get when liquidity just dries up.
And man, it wasn't just equities taking a beating. Bitcoin took an absolute wrecking ball to the chin, fracturing down by nearly 5% to print at $60,660.33. That was driven by deep retail capitulation and some heavy ETF outflows. Even spot gold couldn't escape the gravity, falling back 0.5% to settle at $4,452.20. So, what's the big question? Why exactly did the screens flash bright red across the entire board?
Which brings us to Section 2, the red folder shockwave.
To understand these red screens and find the specific catalyst for this massive liquidation event, we've got to look directly at the economic calendar. At exactly 8:30 a.m. Eastern, the Bureau of Labor Statistics dropped their high-impact non-farm payrolls report. And wow, these numbers threw a massive wrench into the market's near-term right assumptions. U.S. employers added 172,000 jobs in May. That came in noticeably hot against expectations. To add a little fuel to the fire, previous months actually saw upward revisions, all while the unemployment rate held perfectly steady at 4.3%.
Now you turn on the mainstream news networks, and they'll happily spin this kind of job growth as a pure positive, right? More jobs equals a better economy. But down on the trading desk, we don't trade the spin. We trade the structural reality. And the reality is that a resilient labor market gives the Federal Reserve a total green light to keep interest rates highly restrictive for longer. Right now, in this environment, a hiring boom is actually an equity bust because it basically means the era of cheap money, it's not coming back anytime soon. Because of that, the market's reaction was instant, just a completely aggressive repricing of the terminal rate. Now, what's really interesting about this is that we are looking at a dominant 54% probability of a rate hike at the December meeting. That sudden hawkish realization, the fact that rates might actually go up again instead of down, is exactly what sparked this morning's massive liquidation across risk assets.
Moving right along to Section 3, Energy Curve Release Valve.
So, while equities and crypto were scrambling for cover, the energy sector actually acted as this really fascinating structural release valve. Despite massive front-month spot panic trying to whip the energy pits near $95 on all these shifting geopolitical headlines, the outer monster actually bleeding out premium. Case in point, our July 26 Brent crude contract, the /BZN26, managed to lock its baseline close right at 91.89.
And you know, this brilliantly illustrates a vital piece of correct macro analysis. This downside expansion in crude, this softening forward curve, it essentially acts as a corporate tax cut by easing input costs for businesses. It tells us that while the equity flush to 7,364 was incredibly violent, the long-term energy headwind isn't actually expanding. That's the absolute key reason why this whole event looks way more like a sharp macro digestion rather than, the start of some permanent economic collapse.
Next up, Section 4, the yield pressure reality.
Which brings us to the absolute primary driver of today's damage, the brutal reality of yield pressure. We've been tracking the decoupling between corporate cash flows and the fixed income desk for a while now, but today the weight of yields finally slammed risk assets. Following that hot jobs print, long and U.S. Treasury yields caught a vicious bid, holding firmly past that critical 5.0% mark.
And here's why that matters. When the risk-free rate refuses to cool off and stays above 5%, it forces what we call equity risk premium compression.
It's essentially an automated mechanical repricing. Look, mega-cap growth stocks can hide from borrowing costs on pure earnings power for a little while, sure, but when risk-free debt pays this high, institutional managers have literally zero choice. They are going to aggressively lock in their paper stock profits every single time a red folder data point triggers a hawkish scare like this. The math simply forces them to sell stocks and buy yield.
All right, finally, Section 5, Professional Trading Directives.
So how do we navigate the sudden trend shakeout without letting a single red candle make us sloppy? It all comes down to professional trading directives. You have to trade the hard numbers on your screen and stop letting macro goes dictate your execution. So the crucial point is, number one, our core structural anchor right now is the long-term 50-day exponential moving average. As long as the S&P can find a weekly closing anchor and defend that 50 EMA, the primary bull engine is structurally protected. But if it fails to hold, the doors swing wide open for a much deeper correction. Number two, you've got to manage your position sizing tightly in this kind of volatility. And number three, stop guessing tops and bottoms. Seriously, let the moving averages and the hard numbers dictate your execution.
Keep your eyes glued to those charts, folks, and trade the actual numbers in front of you. The technical landscape has definitely shifted. The margin calls have flushed out the weak hands, and the 50-day EMA is our line in the sand right now. Will the bulls step up and defend that structural anchor, or are we staring down the barrel of a larger, systemic unwinding? Only the tape will tell. The question is, are you ready for the morning bell?